Industrials may be facing negative macro data, but Cowen says that despite remaining more cautious on large agricultural equipment in 2024, the space is holding up fairly well in the face of headwinds. Cowen research analyst Matt Elkott joins us now. Okay, so Matt, break down the thesis for us just to start off from perhaps a 10,000-foot view.
Sure, Brad. So as you mentioned, we have seen a slew of negative macro and industrial data. You have the housing slowdown and decreased inventory replenishment needs and interest rates rising, commodity pullback. But we had our conference earlier this month, and companies in the machinery sector, truck equipment, rail equipment sectors, they're not really seeing this slew of negative data manifest in their businesses. For instance, Cummins just had their internal conference with their own customers recently, their OEM customers, and the feedback they got was that demand is still pretty solid, and they expect a strong production year in 2023, and they expect the strength to continue into 2024. Now, this is an area, the Class 8 cycle is an area where we are maybe a bit slightly more cautious than most investors are. But I think, the part of the story is, Brad, we are still catching up from the big surge in demand that we saw after the pandemic. And because of the supply chain disruptions, the industry in many industrial sectors has not really been able to fulfill demand. So it kind of pushed out the cycle a little bit. So we're going to see, deliveries of equipment in 2023 continue to be very strong. 2024 is a more nuanced picture. As you said, we're a bit less positive on ag equipment. I think on the residential construction front, we are cautious, as everybody should be, but we may be a bit less cautious than most because 90% of mortgages are fixed, and that's something we kind of articulated in a note on Thursday. So that should really limit result in a higher floor to the home value contraction than we've seen in prior contractions, which in turn, we are expecting a new construction slump, of course, but it should have a higher floor than previous contractions. And then just as the residential part of construction moderates, towards the end of this year, we'll see some of the infrastructure bill-related orders come in. So it should work out okay for companies like Cat and Deere. But this is kind of like the high picture, the big level view.
Matt, what about what we heard last week from the likes of Nucor and Arconic in terms of their warnings? Do you see any kind of implications there for the machinery makers that you're discussing?
Well, so, on the mining side, some of the commodity companies over the last couple of months have tempered their mining equipment or mining capex slightly by $100 million here, $200 million there. Actually, one, I think, lowered it in 2022 and raised it in 2023. So there's a bit more caution, I think, on mining capex than maybe we had thought would be the case earlier this year when commodity prices were very high. But I'm still expecting a prolonged mining equipment replacement cycle because for about 15 years before the pandemic, we've had many false starts, and it really never caught on. And obviously the mining companies have been under pressure to do more share repurchases in recent years than to invest. So but we've reached the point where we do have to replace equipment. So I think, barring a further material decline in commodity prices, we're probably going to see a mining equipment replacement cycle. And then if you take a much longer term view on the clean energy stuff, EV, you're going to have to find more lithium, nickel, copper, and commodities like that. So that's the secular part of the story that we're going to see unfold in the next couple of decades, probably.
Right, and we've already seen some of the materials warnings come out last week. And so within the kind of replenishment rate that you were outlining a moment ago there, where do we sit within that? And is that on the decline right now?
It's not on the decline. We have started to see some equipment replacement, but it really hasn't taken off in earnest, Brad. So I think, I think if we continue at current commodity prices, we will see increased equipment replacement on the mining side in the coming couple of years. Now, could we have a hiccup if commodity prices fall further? We probably could, but it probably would be a temporary hiccup. But I think if we stay in the general neighborhood of today, we should have a replacement cycle going forward.
All right, a little note of optimism there, Matt Elkott. Thank you so much. Appreciate it. Of Cowen Research. Thanks.